the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In this week's episode, we will discuss the week's important developments with a cover story highlighting why banks tend to go for large write-offs. We have an interview lined up with N Kamakodi, CEO and MD of City Union Bank, where he talks about the bank's future strategy. In our Banking for You section, experts explain why GSTN joining the account aggregator space is good news for MSMEs. And our banking expert Tamal Bandyopadhyay sheds light on the merits of the public credit registry system, besides sharing his expectations for the upcoming RBI meeting. At the end of the episode, we shall discuss the results of the last poll and ask you the question for the next week. Next week, India will be gearing up for the RBI rate announcement. While the market has priced in a rate hike, a BS poll found that the RBI will likely announce a 35 basis point hike, taking the policy rate to 6.25%. In other news, banks ramped up interest rates on deposits to attract funds, with smaller finance banks offering higher rates in some cases to attract more deposits. Deposit growth has lagged behind credit growth this year, and it shall continue to do so as analysts expect credit offtake to stay steady even in the face of rising rates. A discussion on loans is incomplete without a reference to non-performing assets. While Indian banks have been able to curb the NPA menace, a large part is due to massive write-offs. In our cover story this week, we deep dive into why banks went for large write-offs and the truth behind banks' stellar performance. The turnaround story in the banking sector over the last half a decade has been the decline in non-performing assets. After rising to a high of 11.5% of total loans given by the banks in 2017-18, gross non-performing assets or GNPAs or bad loans declined to 5.9% in 2021-22. Banks have even weathered COVID and have been registering record profits. Industry profits zoomed in the second quarter of the fiscal year, with the public sector banks reporting a 50% growth annually and private banks witnessing a 64% rise. However, India's non-performing asset or NPA story hides a vital facet. Has it been improving quality and recoveries that have triggered this performance, or is it the consequence of banks clearing the assets of their books? Data suggests that banks have written off 10 trillion rupees worth of loans off their books in the last 5 years and have only recovered just 13% or 1.32 trillion rupees. A bank write-off of a loan when there is a low chance of recovery. It moves the loan from its asset book and shows it as a loss. It also helps that write-offs work as a tax mitigation strategy. If one includes these write-offs as NPAs and keeps them on banks' books, the total gross non-performing assets rise to over 13% for the industry from the current 5.9%. A business standard analysis shows that even though the ratio of write-offs to GNPAs or gross NPAs has reduced from its peak in 2018-19, the proportion at 20% is still high. Surprisingly, the write-off ratio at private banks at 26.6% was higher than the ratio at public sector banks. Our banking editor Manojit Saha explains the reason behind these huge write-offs.
Write-offs are predominant recourse for lowering gross NPAs, particularly for public sector banks. When a bank writes off a loan, it has to set aside capital, known as provision. Huge amount of write-offs were possible in recent years because the government infused over 3 trillion capital in public sector banks between 2016-17 and 2021. Banks will say that writing off does not mean they stop chasing recovery. In reality, they recover only a fraction from the return of accounts.
Another significant factor for banks opting for write-offs is the failure to capitalize on asset recovery. Asset resolution plans have usually failed to generate value, with banks taking substantial haircuts. Banks recovered only a third of the amount involved under the Insolvency and Bankruptcy Code process in 2021-22. The recoveries have declined over the last few years. Debt recovery tribunals and ARCs have even lower recovery rates. So, are we expected to see more write-offs? We talked to an expert to understand the future course.
I don't think we will go to see a similar kind of a write-off in the next 5 years. Even in fact, it would be even much lower. I don't even expect 20% of that 10 lakh crore to come in. But now, as the banking stands today, there was no bad corporate lending the banks have done in last 3-4 years. The retail is doing quite strong. SME, MSME is in a perfect shape. So, combining all this aspect, it would be very fair to say that banking as such is on a very strong wicket.
The resolution system will have to work for write-offs to reduce. More importantly, banks would need to be mindful of lending. The recent credit growth could push the banking system into a cycle of bad loans again. A discussion on banks these days usually takes one towards the performance of private sector banks. They have consistently outperformed their public sector peers. Business Standard's Raghu Mohan spoke with N Kamakodi, CEO and MD of City Union Bank, on the bank's performance and the focus on efficiency rather than scale.
Welcome to the BS Banking Show, Mr. Kamakodi. Good to have you here.
Hi, Raghu.
Yeah. Question is that you're one of the smallest private banks in the country. How do you hold up your own against your larger peers of the country?
See, the question of large or small doesn't actually play any significant role here. What actually matters is that whether you are adding value to your stakeholders, be it your customers, be it your shareholders, be it your depositors, be it your borrowers. As long as any institution which is able to add value to its stakeholders and also generate a return which is more than the cost of capital, the sustainability will be there continuously. If you see, like say, if you take even any larger, like say, developed countries or whatever, you take any geography for that matter, you have banks which are extremely big, you have banks which are like say smaller. As long as you continue to add value to your stakeholders and as long as you stay relevant to your stakeholders, your existence will not be questioned. And yes, it is a challenging thing that, like say, every year you have to keep asking that question: how are you adding value to your own customers and all? But right from the beginning, I mean, just to give a broader idea, maybe up to the late 80s and early 90s, till the liberalization, we all traditional private sector banks, we wanted to remain small for the fear of getting nationalized. So things changed. After that, we had to completely change our DNA and all. But nevertheless, right from the beginning, the bank has made profit in every year of its, like say, every year from 1904 to current year, and also declared a dividend every year right from 1904 to till date. So we, more than the, like say, just size, we look into the efficiency and the profitability ratios, be it return on assets or return on equity, cost to income ratio and all. In all efficiency and profitability parameters, for many years, our bank had been reasonably at the top position, maybe the top 10% of the industry, and we focus on those matrices which keeps us going.
A substantial portion of your book, nearly 40%, when I last looked at the numbers, is in the MSME segment. How was this portfolio been holding up post-pandemic?
See, if you had a chance to look into our, like say, last 10 years, just to give you a broader idea, up to financial year, say, 16, we had a slippage ratio of about, like say, just under 2% to the closing advances as our slippage to NPA. So after your 17, 18, 19, 17, 18, you had demonetization, then introduction of GST. Somewhere around 2019 calendar year end, you started seeing some amount of like say things like say the where some sort of what you call things were not smoother towards the around December, November, December 2019 and all, when we said we are taking our legs off the growth pedal and all, and immediately in 2-3 months we had COVID. So during the years of 17, 18 and 19, our slippage ratio was about 2 to 2.5%. And during the COVID years of like say 2021 and 22, our slippage ratio to NPA increased between 3 to 3.5%. Now things are getting back to the pre-COVID level of 2 to 2.5%. So basically, the thing is that, like say, many things in unorganized sector are getting into the organized sector. People are entrepreneurs are also finding their way to, like say, organize themselves and all. So in that way, yes, there are fundamental changes in the way businesses are, particularly the small and medium scale businesses are operating in this country. But to greater extent, things have come back to closer to the pre-COVID level. In fact, that is also getting reflected in the data of capacity utilization and all, which typically used to be about around 75 to 80%. Normally, the investment cycle starts when the capacity utilization crosses 85% or so. During COVID period, it came down to maybe 60-65%. Now things are back to that 75 to 80% of pre-COVID level.
Retail banking is a flavor among private banks, but given that millennials are switch loyalties, how are you lapping into the set of clientele?
One thing, basically, like our major focus had been towards what you call self-employed people right from the beginning. Like say, in a country of 130, 140 crore people, you hardly have about 5 to 6 lakh, 5 to 6 crore income tax payers. Bulk of the numbers come from the salaried segment. So the salaried segment in our country is like say too small. So our focus right from the beginning, when we defined like say small and medium scale enterprises, commercial trading and agriculture as our core base constitute about 75-80% of our total loan book, our focus had been more towards self-employed and entrepreneurs type. So our focus on the salaried segment, the retail, what you call, is relatively less. Nevertheless, what we did was that over a period of time, we became bankers for like say many well-reputed educational institutions of our part of the country. So we get those like say engineering students and all who graduate, they become our customers as the student. We focused on the students as the segment. So when they complete their education and they get into like say their profession as an engineer with a software company or any company, so even if 50%, 25 to 50% of them continue the relationship, it started giving us some amount of continuous scheme of things. So that is the way we are keeping our things going, because in future the composition could change. So this is the, and another thing, as I have been repeatedly saying, your things like say stay if you are able to convince your customers that you are adding value to them. So we, through our product offering and through our services, we want to ensure that we continuously add value to that segment. And it could be a minority, but a significant minority to us over a period of time. But our core focus had been to self-employed entrepreneurs to a greater extent.
Can you give us a sense of your branch expansion strategy? Last year, you did a small expansion of 25 branches. How do you see this panning out?
See, we had a record of opening 50 branches every year up to, like say, financial year 20. Pre-COVID, for the, like say, for the previous 10 years, we had about at an average of 50 branches per year. During COVID period, we had to stop, and last year we had 25 branches. So going forward, this year onwards, our planning is to have 50 to 75 branches every year. Is the planning we have. We will be shortly opening our 500th branch in the state of Tamil Nadu. And out of our 727 branches, 490 plus are in the state of Tamil Nadu. The 5 southern states of Telangana, Andhra Pradesh, Karnataka, Kerala, together they constitute about still about 80-85% of our total branch network. We have opened a handful of branches every year in the states of say Maharashtra, Gujarat, Rajasthan and all. We typically take about 10 years to have our deepening presence. After Tamil Nadu, we have in Andhra and Telangana, our presence is there in most of the districts. Now the deepening will start happening towards the taluk and the mandal level. And we have started opening a handful of branches every year in the Rajasthan, Maharashtra, and Gujarat. So maybe in the next 5-6 years, we will be exhausting the districts and start getting into the next level. So we take our time slowly and steadily. We should be touching our maybe say 1,000 branches by 2025-26 is what we see, which appears to be a reasonable target at this point of time.
Thank you, Mr. Kamakodi, for being on our show. Look forward to having you again sometime later.
My pleasure. Thank you, Raghu.
Kamakodi says that what matters is whether you are adding value to your stakeholders and generating a return which is more than the cost of capital. Once this is ensured, sustainability will follow. Although loan growth has picked up, securing a loan is still a very tedious process, especially for small businesses. However, the RBI has a fix. The banking regulator has included the Goods and Services Tax Network or GSTN as an account aggregator. But how does it help? Our experts explain.
There has been a major development in the blossoming account aggregator or AA network space. The RBI recently announced that the Goods and Services Network or GSTN has been onboarded the AA network as a financial information provider or FIP. According to the RBI, this move would facilitate cash flow based lending to small businesses. Till now, these small businesses were not a part of a formal credit delivery system due to a lack of data about their businesses. Financial information providers or FIPs, in short, are institutions that hold user data. As a FIP, GSTN will share customers' information with financial information users via requests through an account aggregator. This information sharing will happen only with the consent of the customer. Basically, a FIP acts as a data repository for an AA. The data with a FIP can only be accessed by an aggregator. These aggregators are not allowed to store any customer data they get access to. According to experts, GSTN coming under the ambit of the AA network will be a boon for India's micro, small and medium enterprises. Now, banks and other lending institutions would be able to assess the creditworthiness of small business owners through verifiable data. Lenders can review the information available with FIPs and take calls on providing loans to such small businesses. This will bring these small businesses under the ambit of institutional credit and build their credit history. This would further help them grow their businesses by getting larger loans from financial institutions. If the unified payments interface change the way payments are made, the AA system might transform how credit is processed and accessed in the country. Launched in September 2021, an AA enables a free and instant exchange of financial data between FIUs and FIPs with the customer's consent. Thus far, nearly 2.5 million accounts have been linked to the AA ecosystem, and around a similar number of consent requests have been fulfilled. All major public and private sector banks are now live on the AA network as FIPs or FIUs. Now, insurance companies and asset management companies are joining the network gradually. Currently, India has 6 account aggregators with operating licenses and 9 with in-principle approval from the RBI.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
RBI believes this would facilitate cash flow-based lending to small businesses. Another system expected to do the same was the Public Credit Registry system, first announced by RBI in 2018. But the system remains elusive. Our consulting editor Tamal explains what a public credit registry is and how it would alter the current framework. He also discusses his expectations for the upcoming RBI MPC meeting. Hi Tamal, thanks for coming on the show.
Thank you.
Yeah, this week's column talks about the public credit registry. Now, the first question that came to my mind was, what's the difference between a credit bureau and a credit registry? As I'm to understand, there are already 4 credit bureaus.
Yeah, then why do you need it? Yeah, one simple answer was given by one of the deputy governors, past deputy governors. Is this, typically the credit bureaus, they are for-profit organizations. But because they are for-profit organizations, they only look for those segments where, it's a bottom line driven. Where in contrast to that, public credit registry is a not for profit. So it's a much, much larger scope here. It's a single window 360-degree view of an entity, be an individual or a corporate entity or MSME, a lender can get. The biggest benefit of this would be the MSME segment, which the banks are not exactly excited about. So once you have PCR in place, it's a sort of architecture to have if you want to deepen the credit market. If you want, it gives you everything that you want to know as a lender.
Now, because we've been talking about lenders, I would like to take you to the issue of write-offs as well. What do you think has been the reason for such large write-offs? 10 lakh crore in 5 years. Is it a failure on the banking side, or did the resolution system need to work better? I believe you've written about it before as well.
No, it's a well, first is in Indian context, we have a very different concept of write-off. It's called technical write-off, which means as a bank, you write it off, but it's parked somewhere there. So once you start recovering, then it adds to your profit, to their bottom line. Yes, thanks to IBC, which came in record time in 2016. It's a weapon for the bank to get into this, but to recover bad loans. It's a very potent weapon because many a time the banks do not exactly use it, but it use it in the sense technically it's not used, but it is used as a threat to the corporate, the rogue corporations. And it's still in the process of fine tuning. Every second day you will find in newspaper how it has been evolving. There have been court cases, there is new sections being added, glitches have been ironed out. So it's 6 year plus that's in this new system is in place. It's still evolving. It's not comparable with many of the developed markets. Recovery was at the first round pretty good because they are the so-called low-hanging fruits. But as we move ahead, things are not as good as it had been in the past. But there have been fine-tuning. It's still evolving.
Because we have the RBI's meeting next week. What are your expectations from the RBI's coming meeting?
Well, rate hike for sure. This time RBI would not have the latest inflation number. It will be the policy would be before the inflation number comes up.
Yeah.
RBI will also not have the advantage of FOMC meeting ahead of RBI meeting, which typically happens.
Yeah.
Because FOMC meeting will be more than a week later than the RBI policy. So this is the backdrop. Inflation is high. It would continue to be beyond the Reserve Bank of India's upper band for months now. My hunch is probably not 50 bips. Probably it could be anything between 25 and 35 bips. I would personally prefer a 35 bips hike, which would take to 6.25, and then see how the FOMC reacts. What's the inflation in the other parts of the world, particularly in US, and move ahead. But RBI will have there's no escape from a rate hike, because you need to also see that budget is February and the next policy would be after the budget, and then election is in 2024. So there would not be much scope, even though central bank is independent, but pressure on it against more hikes will increase in the next financial year.
Thank you. Thanks a lot for your time. We hope to see you again next week. Thank you.
Thanks, Ishan. Thank you.
Kamal expects a 35 basis point hike in the current meeting, but says it would be difficult to institute aggressive rate hikes as elections draw closer. Last week, we asked you if the RBI should try to bring the rupee under 80 or not. Nearly 3 out of 4 people that responded to the poll want the RBI to bring the rupee back under 80. Some of it may already be happening as the Fed eases its policy stance. This week, our question pertains to the upcoming monetary policy meeting. What should be the quantum of the rate hike in the forthcoming meeting? You can respond on Twitter, Instagram, Telegram, LinkedIn, and our website. Our polls open on Friday. While a rate hike is penciled in for this meeting, what remains to be seen if the RBI will raise rates in the last meeting of this fiscal. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.